Hi everyone, and welcome to our our third lesson of 3 in our Chapter 9 course in our entrepreneurship course, dealing with business operations. And in this lesson 9.3, we're talking about determining price. So our objective in this lesson is to compare pricing policies, structures, and strategies to gain insights into effective pricing practices so that you can make informed decisions regarding your own business ventures. So, price factors and determination strategies. Well, let's start with price factors. There are several factors that can influence the selling price of a product or service, including consumer credit. We're going to talk about some of these. We're also going to talk later about price determination strategies. Now, pricing decisions are crucial as they directly impact profitability, market position, and customer perceptions. These determination strategies are key considerations and approaches that businesses can employ to determine the optimal pricing for their products and services. All right, so let's look at some of these price factors. First off, let's talk about a definition of price determination. This is the process of setting the price of a product or a service in the market, and it is influenced by various factors, including consumer demand, competition, production costs, and something called the elasticity of demand. Now, talking about elasticity, there's something called price elasticity. This is the level of sensitivity in the quantity demanded when there are changes in price. Elastic demand signifies a higher degree of sensitivity, and inelastic demand implies a lower degree of sensitivity. Now, more price factors, such as production costs. This is the cost of labor, manufacturing, raw materials, and other overhead expenses that directly influence the selling price of a product. Higher production costs generally result in higher prices. Another factor is the market and the consumer demand. This is the total quantity of a product or service that consumers are willing and able to purchase at a given price and within a specific market or industry. Competition can also be a price factor. The competitive landscape impacts pricing decisions all the time. Businesses must consider the prices charged by their competitors to remain competitive in the marketplace. Continuing on with pricing factors, there's consumer perception. This is the consumer perception of value affects the pricing. When customers perceive a product or service to possess superior quality or distinctive features, businesses can then typically establish higher price points. Consumer credit is also a factor. The availability and terms of consumer credit influence purchasing power and consumer behavior. Offering consumer credit can attract customers and enable them to make larger purchases, potentially then justifying higher prices. Economic factors or economic conditions such as income levels, interest rates, and inflation can heavily influence pricing decisions. Businesses may adjust prices to account for changes in the overall economic environment. Then there's something called key performance indicators, or KPIs. These are quantifiable metrics used to measure and evaluate performance towards a specific goal. The KPIs provide valuable data for tracking progress and informing decision-making at various levels of the organization. Price determination takes both KPIs and price elasticity into account by adjusting prices to maximize revenue based on both the KPI data as well as the responsiveness of consumer demand to price changes. All right, let's talk about price determination strategies. So there are several. So there's market-based pricing, cost-based pricing, value-based pricing, dynamic pricing, and psychological pricing. We're going to talk about each of these individually, starting with market-based pricing. This involves setting prices based on the prevailing market conditions and the competitive landscape. It requires a thorough understanding of your target market, including customer preferences, purchasing power, their willingness to pay. And by analyzing competitors' prices, you can position your product competitively while ensuring it provides value to your customers. Next in our price determination strategies is cost-based pricing. This involves setting prices by considering the costs associated with producing and delivering a product or a service. By adding a desired profit margin to the total cost, businesses can arrive at a price that covers expenses and generates a satisfactory return. Next in our price determination strategies is value-based pricing. This involves setting the price of a product or service based on the perceived value it delivers to customers. This approach necessitates a comprehensive understanding of the benefits, features, and distinctive selling points of the offering. By aligning the price with the value customers place on your product, you can capture a fair share of the market and create a perception of premium quality. Next is dynamic pricing. This is a strategy employed by various industries such as travel, like airlines, hotels, etc., e-commerce, Amazon, eBay, etc., and ride-sharing services like Uber and Lyft. Prices are adjusted in real time based on market demand and supply and any other factors and/or variables. Finally, there is psychological pricing. This is a tactic utilized to influence purchasing decisions by capitalizing on human perception and psychology. Strategies like setting prices at $9.99 instead of $10. This is something known as charm pricing. Or you could offer discounts for bundles. For example, BOGO. BOGO typically means buy one, get one, but and it's a general term that is used for offering in bundles, but it can apply also to like buy two get one free. Okay, but so hence the idea of buy one get one, BOGO. Okay, psychological pricing can create a perception of a better deal and drive customer interest, and understanding the psychological aspects of pricing can significantly impact consumer behavior. All right, and so that is our lesson 9.3 on pricing factors and price determination strategies, where our objective was to compare pricing policies, structures, and strategies to gain insights into effective pricing practices and to make informed decisions regarding your own business ventures.